All right, guys. Today we want to do something a little bit different. I brought in a special guest, Quentin Johnson from Intrepid Advisors, also a great friend of mine. And we want to talk a little bit about what some of the smarter money, quote unquote, insiders of people or of investors are doing. Quentin, he'll tell us a little bit about kind of what he does and then the kind of people he talks to. But Quentin's also a former managing director at Deloitte, so he's been working with money managers. Substantial and very smart money guys for pretty much all of his career. So I don't know, Quentin, if you want to maybe tell us just a little bit of what you're doing, and then we'll just go right into it and see what we can tell people we're seeing that people are doing, because people are buying. They're definitely buying stuff.
Yeah. Thank you, Serge. Yeah, former director at Deloitte for 14 years. Since the entire time I was there, I've worked with alternative fund managers, and so now I have a company that I formed earlier this or last year, I suppose, in doing the same thing. So I work very closely with alternative fund managers, and I do primarily operational advisory stuff, and a lot of that has to do with investment strategies and how you manage portfolio companies and that type of thing. But what we're seeing now, especially as you are as well, is an economic shock as a result of obviously the coronavirus. And so we're seeing had a lot of different conversations and seen a lot of different recent strategies and discussions about what the strategy should be, both short term and long term. So thank you for having me, Serge. Happy to talk about what I've been listening to on the street.
Yeah, awesome. I mean, I know one of the things that that really differentiates the retail investor from the institutional investors is first of all, obviously, access to resources and just that's their profession, right? So that's what they do. They should be better for the most part, or at least pretend to be better. But I know one of the things that we're doing at our company for our clients and our own portfolios is certainly looking at things from a bit of a value perspective. There are going to be the recessions and the bear markets on the equity front and on the credit side, which I want to hit on as well a bit. They tend to come in waves, so it's not just one thing swooshing and you're done. This is like a serious crisis now. This is not what any of the mini drawdowns we had over the past 10 years. This is the serious thing now, and the V-shaped recovery. I mean, I don't want to never say never, but it's very unlikely at this point. But I know just from a value perspective, I would love to get your thoughts, kind of what you're hearing, what people are doing, and your own thoughts on that as well.
Yeah, no, thank you. I think it's a good question, especially from a value perspective. And depends on what your market perspective is and what your trading strategy is. But if you are looking from a value perspective, then I think that ultimately you need to look at the fundamentals of the companies that you're buying, right? So you're looking at PE ratios and earnings, and that's important clearly from a long term. And if you look at the reason we are currently in this crisis, it's different than the dot-com bubble where you had a problem with the fundamentals of the companies. They weren't there. They were in essence trading on smoke and mirrors, where that would have been a bad long-term strategy clearly. But then you had the 2008 crash, right? That was a fundamental problem with the balance sheets, right? They were selling mortgage-backed securities, and then they couldn't service the debts, and that fell through, right? But this is different. This is not an internal, fundamental change to the companies that we're looking at, the global companies. In essence, the fundamentals for those companies haven't changed. The customer bases haven't changed. Their products haven't changed. What has changed is the demand, and clearly the challenges with the supply chain.
It's a demand shock.
It's a demand shock, and so it's something we haven't experienced in our lifetime, really. And so it's how do you manage that? And so because it's new, nobody's really had to deal with it before. And so that's why you see the volatility in the marketplace. But I think that, looking at taking a step back and saying, well, when did this happen and how did it impact the market? That's, difficult to understand what's going to happen on a day-to-day basis. But if you look from a time perspective, what happened before this event, and you look at the fundamentals of the company, which ones had strong balance sheets, which ones were values are increasing based on their sales and their market performance, right? And ask yourself the question, will that change once this is resolved? And yeah, we don't know when it's going to be resolved, but something will happen, whether it be vaccine or just it just goes through the people in the countries, and they get better, and then it goes back to normal. And then the fundamentals that existed prior to this shock were very likely to come back again. And so travel industry and sports industries and things that are currently just being decimated, they're going to pick up. People will watch baseball. People will watch basketball when people get better again. So from a value side, it's thinking about what you can look at now, what stocks you can identify now that are really good values to buy while their market value is low.
Yeah, yeah, no, absolutely. And we've been buying names like JP Morgan a little bit, and the terminology that we're using internally with clients, and we're hearing from our larger clients like family offices really is the word nibbling. Like it's not like we're definitely not going all in. A lot of people, I don't know, anyone that I'm talking to is going all in, but there are pockets of opportunities, even maybe in the broader indices to an extent. But what I want to touch on a little bit is the credit markets, and I don't want to get all dork up on credit market talk, but what I have in the chart is I brought up an ETF, which is the U.S. listed ETF called ticker symbol HYG, which is basically junk bonds. And I think this is just kind of want to show people this is different from any of the crises we've had, or many crises we've had over the past decade. And you can only see it half as bad as really in the market if you look at credit default swaps. There's real risk of a major default, and in my opinion, definitely we're going to have some major defaults, not just in the high yield market, which is what this is, but even in investment grade, which is you can look at U.S. investment grade stuff through an ETF like the LQD, which is some investment grade stuff. But I think, I'd love to get your perspective, not so much detail specific on credit markets, but I would assume you're hearing and you probably agree that it's a good time to do some basic work on company balance sheets. I know for a lot of people, they're not sort of they haven't studied that or ever done it, but it's really not that hard to do. You can look at how much outstanding debt they have and that kind of simple stuff, right?
Yeah, and I think that it's a good thing. Now, I'm not an expert in credit markets myself, but ultimately from a fundamental company perspective, credit is cheap, and credit was cheap before this event, and now credit's even cheaper. And with the amount of money being pushed into the marketplace, you're going to have companies that do survive, that have strengthened balance sheets potentially, right? And so what you might see is a number of the big players in any given industry take advantage when the markets start to turn, to become acquisitive and look at the companies that may have come into the industry recently, that they may want to buy to get rid of them as a competitor, or they may want to see some may have fundamental problems other than the virus impacting their demand and supply chains, where the Amazons and the retailers, Walmart, might identify as an opportunity to consolidate, to buy them and to grow even bigger through acquisition. So I think that access to capital could be used by the big players who are in a strong position to just grow and become even bigger after this crisis.
I think it's true. And one of the prime examples is, can you see my screen, by the way, the chart?
I can, yeah.
Yeah, okay. Could have asked you that a few minutes ago, but this is ExxonMobil, and anything can happen. But if you look at a lot of the junk bonds, or in the energy market, and obviously that's been a big underperformer now for some time. I mean, if these companies are going to be interested in doing some acquisitions and figuring out opportunities in the U.S. shale markets and in other places. So this is one of those areas I think would be quite interesting. But yeah, I mean, it's one of those situations where I'm not quite sure we want to really jump ahead too much and go all in, but there's going to be opportunity. And I think for the most part, it's important that people understand it takes time. And speaking of credit markets, by the way, and I'll just quickly bring up the LQD ETF, and these are long-term monthly charts, by the way. Like each one of these bars is 1 month. This is long. It goes back to 2003 in this case, and so on and so forth. But one of the things that we discussed internally with a client just yesterday actually is if you look at these programs that are being rolled out globally, I'm just talking more US right now, they're going to look into buying investment grade credit, investment grade bonds. So one of the simple things you can do is jump on the bandwagon of what the Fed is buying. So I think at this point you want to try to go outlandish and buy something some company that's the debt's not trading at 40 cents in the dollar, and you think they're going to survive because you like their burritos that they're selling or whatever. But if you can buy the same stuff that the Fed is buying, which by the way was some of the best trades I've ever seen in my life, was back in, I want to say it was 2010,
Hmm.
maybe late 2009, when the Fed literally told you they're buying Citigroup. It was
Yep.
trading at like $2. They told you, it was there's in writing they're going to buy it at 4.
Right.
And this is the kind of stuff that's going to happen again right now. And I'm working a whole thing for that for investors. But I think that's the kind of opportunity that I'm sure you're hearing from some people as well.
No, I absolutely agree. We don't, I mean, obviously don't know what's going to happen with regards to public announcements about acquisitions, but you can certainly take a look at what other uh, market investor in market leading investors are doing and see what they're buying. That's that you can get access to that information anywhere. A lot of people will give interviews and tell you what they're looking at.
Yeah.
There was just a article published, Market Watch, about what Warren Buffett was holding, and for example, in all of his holdings are strong companies. Goldman Sachs, Coca-Cola, Apple, but they're all down significantly. And so you can take
The
that
airlines, right? He owns a big chunk of that.
exactly right. Yeah, yeah. I mean, the airlines are and be careful on the airlines, because clearly the bigger players, the Deltas and the American Airlines, they're not going to go under because they're going to be essential to the U.S. And the U.S. government will prop them up as much as they can. But the smaller new entrants to the market might have some challenges. But I think if you look at the fundamental companies that are really market leaders, those are the ones that are going to be held, and you can get them on a cheap.
Yeah, yeah, and it's interesting because I know you just spoke offline before we hit the record button here. But one of the things that you said, and this has just been really in top of my mind as well for the past couple of weeks, is you have an opportunity now to actually buy certain companies cheaper than than where Buffett bought them. Because Buffett
Yeah.
usually doesn't. People are not aware. Buffett doesn't go and buy stock. Like he does deals. He gets preferred
Mhm.
stock and this, that, and board and whatever. But you actually have an opportunity in some names to buy them now cheaper than Buffett ever had. And I think I'm not quite sure. I know he bought ExxonMobil um, years ago, but he definitely didn't buy it before 2009. I think he bought it like in the mid 14, 15, I don't know, somewhere within there. So you're getting a better deal now. I'm sure you had dividends and everything, so he's not in the hole as much as the chart looks like, but that's interesting.
Yeah, and again, just be careful when you're buying, and don't just jump into these big companies, because I think Boeing's a great example. Boeing went up,
Yep.
their value went up 60% uh, over yesterday from what it was trading at. It's still well below its trading average of about $400. I think it's down to $160 a share now, which might seem like it's a great purchase because it's down below its historical average. But if you think about the fundamental problems with that company and the reason it's down that low, it's because of the coronavirus and because airlines are not flying anymore. But the 737 Max and all these other challenges it's faced, there's more fundamental issues with that company. I'm not saying it's not a buy, because it
Yeah,
is at a very low price right now, but there's other factors that really need to be considered that
yeah,
weren't just impacted the share, that didn't just impact the share price, the coronavirus, right? Something else, the fundamentals, or something else, if that impacted, then take a bit of a wary approach. But
yeah,
if the company was only impacted by this and otherwise it's a good
yeah.
company, worth considering.
No, absolutely, and that's really kind of the one of the reasons why I wanted to get you on and talk with you publicly is because uh, we tend to focus a bit more on the proactive side. In a normal market environment, of course, while we have our longer term buckets and all that stuff for our clients and ourselves. But this is really very much a situation where you either trade minute by minute, which I
Mm,
don't suggest to anyone
yeah,
for the most part, or you start looking at stuff from a whether we want to use the word value, which I think is a bit dangerous, or just blood on the streets kind of investor, which is maybe more what's going on right now. And so I think people need to be careful right now with having time frames that are too short. I think a time
yeah,
frame of at least a few months, maybe a few quarters, is probably appropriate. And I know a lot of people. One of the most difficult things I find people have is switching their time frames. So some people might put on a trade they like to hold for a couple days or a couple of weeks, but they can't distinguish how that trade may be totally different if they have a long-term investment in the same, let's say, stock. They
yep.
cannot disassociate that, but you really, right now, you have to, right? You're either going to do a trade or you buy ExxonMobil because you think over the next 5 or 10 years, or maybe 2 years, it's going to look better.
Yeah, I agree. And there's a lot of things that are going to really make people, want to jump into the marketplace. Like today, for example, the U.S. is going to have the job claims announcements, right? Just unemployment. It's going to the estimates are big. So between 1 and 4 million unemployed people in the U.S., which is going to really impact markets. J.P. Morgan, or sorry, Goldman Sachs came out recently and said that the market, they're expecting the market to contract, the economy, the GDP to contract by 7.5% in the second quarter. In the 2008 crash, it only contracted by 2.3, so that's significantly greater than that. So there's going to be a lot of downward pressure on the market. So people might want to jump in, and take advantage of that. But again, if you're looking at a more of a long-term play, the market's already low. It might get lower. Some things might happen to make it higher. Regardless, if you're buying in the short term and holding for the long term, you don't have to worry as much about the day-to-day levels.
Yeah, exactly. And I think that's not only is that a healthier, and again, each environment's a bit different, but I think right now, and obviously you and I are agreeing in that right now is not the time to try to be a hero and put on a trade that, may or may not work. And you may make a ton of money if you're right for the next 2 days, but you have about a 50-50 chance of that working out because of the volatility. So the much better odds right now is in trying to find things, whether it's in the equity market using something as simple as an ETF, or maybe you're a bit more of a deeper pocket investor, you start looking at credit or bond markets. But anyway, man, listen, thanks for coming on. I really appreciate it.
Thanks
It's
for having
been
me.
great fun, and I'm sure a lot of people are going to find value. So if you guys enjoy this, give us a thumbs up, like, subscribe, and we'll put Quentin's bio down in the description link as well. Thanks, guys.
Great. Thank you. Cheers.